Hello everyone, welcome back to Chart Engineers. This is the second video in the syllabus, and today we will be going over liquidity. We will talk about what liquidity is, what it means, and how we trade it. Liquidity is one of the most important concepts that we teach here at Chart Engineers, as a lot of our trading and understanding of the markets is based around liquidity. So a lot of you may have heard the word liquidity before, but might not fully understand what it means. So hopefully by the end of this video you'll have a much better understanding of it. So firstly, what is liquidity? Liquidity in other terms just means money, and by that we mean how much money there is in the market and how liquid the markets are. There's more than $5 trillion traded per day in the foreign exchange, crypto and stock market. This means that the market is very liquid, which is good for us because this allows us to have much more opportunities to trade the markets. Liquidity moves the market from point A to point B, which means that if there was no liquidity, then the markets would not move at all. So in high liquid markets, there's a lot of movement, and this is good for us because we can capitalize on this movement by trading the markets. So here at Chart Engineers, we trade liquidity by using a concept called liquidity rates, and by the end of this video you should have a good understanding of what liquidity rates are and how we use them to navigate through the markets. Liquidity rates are a very important tool that we use in our trading, so it is essential that you understand how to spot and identify them as soon as possible. So I'll show you a quick example of two liquidity rates. So here we've got a fractal high, and to recap what a fractal high is, it is a 3-candle pattern where the middle candle wick is the highest point compared to the candle on the left and the candle on the right. When price creates a fractal high and then later comes back like it has here, and it only wicks through the high and the body of the candle closes below the high, then this is what we would call a liquidity raid. So it is only a liquidity raid when the candle body fails to close above the fractal high. Another example is where we have a liquidity raid to the bottom side. So here we have a fractal low, which is a 3-candle pattern where the middle candle wick is the lowest point compared to the candle on the left and to the candle on the right. When price comes back to it like it has here and only wicks through it and the body of the candle fails to close below the low, then this is what we call a liquidity raid. So in both of these examples, it shows that only the wick should go through the fractal and not the whole body. So if the whole body closed below or above the low or high, then that would be a market structure break. So it is essential that you understand the difference between a market structure break and a liquidity raid. We'll go through that in the next slide. Liquidity raids and market structure breaks can be confusing at first, as they might seem a bit similar. So it is best to understand the difference between the two as soon as possible. Firstly, here is the liquidity raid, and as we discussed before, price has come back to a fractal high and fails to close above it. So only the wick goes through the fractal high, and usually once we get a liquidity raid like here and we raid a high, we could potentially have a reversal in the market. So price may start going down. If we have a liquidity raid of a fractal low, then price may reverse and start going up. And I'll explain this in more detail further along the video. So here's an example of a bullish market structure break. This is when the body of the candle closes above the high. This is different to a liquidity raid because a raid would close below the high. So when there's a structure break, it usually means that price will continue to go in the direction of which it broke. So the main difference between a liquidity raid and a market structure break is that liquidity raids are a reversal pattern and market structure breaks are a continuation pattern. So we now understand the difference between a liquidity raid and a market structure break. So we can now move on to the next slide, which is about stop losses. So what is a stop loss? A stop loss is just a buy or sell order. When you enter a trade, you would put a stop loss where your invalidation area is, and this is because you believe that if the markets get to your invalidation area, then your idea was incorrect and you want to close your position. However, although they are called stop losses, what they actually are just other types of orders, and they are buy or sell orders. So to get out of a long position, you need to sell, and to get out of a short position, you need to buy. So I'll explain the first one. So to get out of a long position, you need to sell, and what this means is that your stop loss is a sell order, as the only way to exit the market is by selling your position back to the market, and you are selling it at a worse price than what you bought it at. So this is why you lose money when your stops get triggered when you are long in the market. And to get out of a short position, you need to buy, and this is when price hits your stop loss. It really means you have a buy order here, as the only way to exit the market is by buying back your position at a more expensive price. So that's why you lose money when your stop gets triggered when you're shorting the market. So the last point is that trading is a zero-sum game, and I will explain what that means in the next couple of slides. Trading is a zero-sum game, and what this means is that for one person to make a gain, then another person has to make a loss. So in trading terms, for one person to be taking long positions, then there would have to be people on the other side of the market who are short in the markets. And as they both can't be correct, as price will either go up or down, it means that one of them will make profit whilst the other will lose some of their capital. That's what we spoke about regarding stop losses. So if you're in a long position and your stop gets hit, there are people on the other side of the market who are in short positions, so you lost your money while they're in profit. And these rules apply to all types of market participants, and for this example, I will speak about two types of speculators, one being retail speculators and the other being institutional speculators. So the zero-sum game rule applies to all types of speculators, whether you're retail or institutional. The main difference between the two is how much money that they actually trade. So the average order for a retail trader may be £1,000 compared to an institutional trader who's maybe £100,000, and as we know, that's a big difference. So this can be a problem for the institutional speculators because they need people on the other side of the markets so they can trade against them, as trading is a zero-sum game. So what they do is create fractal highs and lows and engineer liquidity, and that's what we are going to go over in the next couple of slides. So now that we understand the theory behind liquidity raids, we can put that theory into practice. So here, price has made a high and a low, which retail speculators may see as support and resistance. And what they usually do is they would wait for price to either break the resistance, and that's when they will look for longs, or they would wait for price to break support, and that's where they will look to short price. Here we see that price eventually breaks support, and what a lot of retail speculators do is short when price breaks support, as there's a break and retest of the support level. They do this and they usually have their stops resting above resistance. So here's a break and retest. So their trade will look something like this, with their entries as a support line and their stop loss above the resistance. So there may be hundreds of retail speculators who are all taking the exact same trade with their stops resting above here, and this creates a large sum of liquidity above the high. And I'm sure a lot of people have been in this situation where they short price and their stop loss is above resistance, and we see that price comes up and stops them out. And this is because, as we said earlier, there's a large sum of liquidity above the high. So institutional speculators understand this and manipulate price to reach these highs. And what this does is that all of the retail speculators who have their stops above the high or their buy orders have been triggered. So they have lost their money. So what happens to all of that money? All of those buy orders are then paired with the institutional traders' sell orders. And we now see what happens after all those orders are paired. We see that price goes in the direction that was anticipated by the retail speculators. However, they are not in the trade because of the liquidity raid. So if you could not tell where the liquidity rate is on this chart, I'll just quickly mark it out for you. So here, so above that high, above that fractal high was where all the liquidity was, all the retail speculators buy orders, their stop losses, and then where the liquidity rate is where the retail speculators buy orders got paired with the institutional traders sell orders. So what that means is that the retail speculators lost their money and the institutional traders took their money, and we know that because trading is a zero-sum game. So now that you understand what liquidity rates are and how to identify them, it is now up to you to backtest them. So here I've got an example of a chart, and we will mark out a few of the liquidity rates and see what price does at these levels. So here's the first one. Price fails to close above the high, so we rated it and we see that price drops 2 candles after that, and each candle on this chart represents 1 week, as it's a Euro USD weekly chart, so that is a lot of pips. And then we get the next raid, price goes up for the next 3 candles. We then get another raid and price starts to drop. Another raid, we get 2 candles where price is above the raid, and then we just keep marking them out, and we see that once we get a raid, we either get a full reversal or a little reaction. So it's important to understand that liquidity rates are good to mark out and understand, as they will allow us to get a direction in the market, as more often than not we will get some sort of reaction or reversal from them. So to backtest liquidity rates, I would suggest you open up a chart and backtest rates from the weekly down to the H1, and what this will do is help train your eyes to identify them in live market conditions. So yeah guys, that's the end of this video, and if you've got any questions regarding liquidity rates, then don't hesitate to ask in the Discord server, as we'll all be more than happy to help.